Will you run out of money when you retire? Imagine that you've worked all of your life to save for retirement, but then you get to your late 70s or whenever, and the money runs out. And then you've got to make big changes to how you live your life. Well, today, I want to run through how to avoid that at all costs. Hi, and welcome back to the channel. My name is Pete Matthew, and I'm a chartered financial planner based here in the UK. In the last video, which was a few weeks ago, December's been challenging, I covered investing in retirement and introduced a concept called the Cashflow ladder. I'll put a link to that video in the description in case you need to go back and watch it. Now, the point of the Cashflow ladder is to try to minimize damage to your portfolio from having to sell investments and pension funds while they are distressed. That means down in value. Here's how it works. Chances are that there is a difference between our income and our outgoings in retirement, and the difference is what we're going to need to draw from capital. Once we've identified how much we're going to need to draw each year, then we can make sure that we have the right money invested in the right ways. And we do that like this. Money that you're going to need in the next 2 years or so is held in cash. It's risk-free. Money you're going to need in 3 to 5 years from now is invested a notch down from your ordinary risk profile. So it is invested, but just a little bit more cautiously, and I call that risk minus. Now, money you're not going to need for between 6 and 10 years is invested according to your normal risk profile. And finally, any money that you know you're not going to need for at least 10 years, that can be pushed a little bit harder and made to work. And you can invest it a notch above your normal risk profile. And I call that risk plus. Now, this will need to be reviewed regularly as your spending needs change, but that's the basic principle. Now, of course, if it was that simple, it would be fine, but there are other concerns at play here. Most of us have money in different tax wrappers like pensions and ISAs, and that complicates things a little bit. There may be advantages, for example, to draw money from one tax wrapper over another, but that's going to be unique to your situation. There's kind of no universal rules for this. And so we end up with a kind of matrix, which includes the wrappers that we have on it, and I tend to put these across the top. So now we need to think about where is best to draw the money we need when we need it. And tax is obviously a big factor here, and we need to control that if we can. So here's a worked example. And as we're going through this, keep two things in mind. Firstly, I've got a downloadable version of what I'm going through here with a blank copy that you can complete for yourself. Also, I've got a couple of simplified versions of the ladder towards the end of the video. So here's our example, and let's say that you need £45,000 a year to live on, and you're a couple. You've both got pension funds, you've both got ISAs. Oh, and for our purposes here, you're called Jane and Chris. We're going to keep this really simple and assume that the $45,000 you need to live on is the same in each of the next 10 years, forgetting inflation for now. To factor in inflation, you're just going to need to increase these figures a little bit each year. Let's also say that neither of you have any other income for the first 5 years, and so you've got a personal income tax allowance going unused. Well, you might want to draw up to the personal allowance from your pension funds, perhaps using off-plus payments. I'll link to a video about how to take money out from a pension in the description. As I'm shooting this right now at the end of 2023, you can take £16,760 each year from a pension via the off-plus method, and you won't pay any income tax, assuming you have zero other income. So £12,570 would be potentially taxable, but would fall into your personal allowance and so would be tax-free. And the other £4,190 is the 25% tax-free cash. Now, there are two of you, and you've both got pension funds, so we can do this twice, and that gives us $33,520 of spendable money. And we could maybe then just take the rest of what we need from the bank. So you would need to make sure that you have enough money for 2 years' worth of pension withdrawals in cash inside your pension, and enough cash in the bank too. And so for those 2 years, in total, we need £90,000 in cash to cover the first 2 years of withdrawals. In fact, let's just say that everything stays broadly the same for the first 5 years. Keeps it nice and simple. And so we can also populate the years 3 to 5 rung of the ladder in the same way. But maybe we'd like to change the car in year 5. Let's just assume the cost of that is £20,000. So in year 5, we now need to draw £65,000. Well, we might not want to draw that from our pension because we're going to pay tax on it. So maybe we'll decide to draw the extra 20 grand we need for the car, half each from the ISAs. So we can now see how much money we need in the year 3 to 5 rung of the ladder. it's £155,000. And that can be invested, but should be a notch down from our normal risk profile, risk minus. Hope you're sticking with me so far. If you are, and this is useful, please like the video and subscribe to the channel if you're not already. It really helps, so thank you. Okay, we keep working from the bottom up. So let's say that now Jane has a pension kicking in year 6 that's gonna pay her 14 grand a year. So we can now reduce the amount that the couple need to draw from capital by that amount, reducing 45,000 down to 31,000 a year. In year 8, her state pension kicks in at 11,000 a year, roughly. So we can reduce the draw from year 8 onwards by that same amount. So now we're down to £20,000. In year 10, they want to change the car again, this time for 30 grand, say. And so that means they need to draw £50,000 in that year, on top of Jane's other income sources. Chris is a bit younger, by the way, so he still has no income coming in, so he might as well still use his personal allowance and draw from his pension fund. Jane is now a taxpayer, so we might look to draw the balance of what they need in each year from their ISAs again. And maybe the car payment comes from the bank. So again, we've got a good idea now of the amounts needed to be drawn from each place, and therefore how much needs to be invested at that year 5 to 10 level, that is, according to our normal risk profile. And finally, because we know the rest of the couple's funds don't need to be touched for at least 10 years, everything else can be pushed a little bit harder, invested for growth a notch above their usual risk profile, what I would call risk plus. Now, believe it or not, that's a fairly simple example, but it's no good to just set things up and forget them for 10 years. For this to work, it needs to be reviewed each year because we're a year further on. Essentially, though, the premise remains the same. Because we've used a year of cash up, we need to top up that cash, hopefully from profit in our investments. We just move money down the ladder from wherever there is profit and top up our cash first and then redistribute the other rungs of the ladder accordingly. But if our invested money is not showing a profit because markets are having a rough time, we can defer topping up the cash for at least another 6 months, perhaps up to another year. And in the vast majority of cases, a blended multi-asset portfolio will recover within 2 years, but not always. And if it hasn't, then we might need to sell down assets maybe every 3 months, say, to try and minimize the impact of selling at a loss until things recover properly. Now, if all this sounds like too much work and you're doubting me here that that's a simple example, I've got an even simpler version for you. So maybe you only have 3 rungs on the ladder. You hold 3 years worth of spending in cash, another 5 years according to your risk profile, and then everything from year 9 onwards, say, at the risk plus level. This will definitely require less management, but we can go even simpler if you like. Only 2 rungs now, 4 years of spending in cash, and the rest of your money is invested according to your risk profile. Really, this barely qualifies as a ladder, but if you want an easy life and don't mind holding a lot of money in cash, this would work for you. And then there's a final version, which looks kind of similar, but here we have 2 years worth of spending needs in cash, but we actually draw from the invested portion. But we have a kind of a rule that if the portfolio declines in value in any, say, 3 or 6 month period, then we switch to spending cash until it recovers. So as you can imagine, there's a ton of detail here that I just can't go into because it'd be a really long video. You know, is there a correct order of withdrawals? What happens if markets fall for more than 2 years and we start spending invested money? How do I actually separate the rungs of the ladder within my pension or my ISA? Well, subscribe to the channel for more on this subject in future videos. But also check out Meaningful Academy for more detail on this, and specifically the retirement planning course inside the Academy. Go to meaningfulacademy.com/retirement planning and check it out. And if you decide it's for you, use the coupon code YouTube for a discount. I always say that setting up and managing a cash flow ladder is easier to do than it is to explain, but remember, there are those simplified versions too. The point, remember, is to try and reduce the likelihood of you drawing from invested capital while it is distressed. It won't eliminate that chance entirely, but it will minimize it. And in so doing, as long as you're also managing your spending levels relative to your income and your capital, it'll give your invested money the best chance of outliving you. So thanks for watching. We've gone fairly deep here and I'm grateful for your time. Like the video and subscribe to the channel if it's useful and if you're not already, and I'll see you in the next video.